like I'm saying, the returns inwards would be subtracted because the person bought our laptops. Let's say okay sells laptops. So the person came to buy the laptops. Then he realized that maybe one particular laptop is false or there is a problem with it. So he returned it to us. So by he returning it to us, he would we will receive the laptop. That's why we call it is a return, but this time it's coming into the business because the person is returning our property to us. That's why we call it return inwards. Another name is sales returns. So since he's returning the good, it is prudence that we give the person his money. Please, you understand? So that's why we subtract the figure from it. So the returns inward figure from the question is 120, or yes, I think it's 120. So we subtract that one, subtract it. What do we get? 5970 minus 120, which is 5850. Okay. So this becomes the net sales. We are done. So we are done with sales. Then we say less cost of sales. Now, this is because of the matching concept. This is the sales we generated. Now we have to less the cost we incur on selling those goods. The cost we incurred on selling those goods. Now, let me see whether I'll get this here. Or not get this. Let me try. Now, you see, let's say we are selling. We have some goods already. Let's say 10. Okay. But this 10 wouldn't be enough for us. Okay. So we have to buy more in addition. And that's our purchase. So let's say we bought 90, then we got 100. Now, when in buying these goods, you will see that the cost of transporting the goods from the warehouse to from the market to your warehouse is called carriage input or delivery cost. So that cost you should incur. So let's say the cost of carrying the goods to your warehouse is 20 cedis. So when you add it to 120, and let's say you realize that some of the goods were bad, so you returned it. Let's say 15. So when you return that 15, you'll be left with what? 105. So that return outward should also be subtracted to get the cost of goods available. All these things should be done. Please, you understand?
Yes, but you are mixing amount with the number of books bought.
Oh, that one I was restricting. I was okay, okay. I get you. I get you. So let me take it into figures. I was doing it okay, I was doing it with respect to quantity, not the value or not the amount. Okay, so let me do it in respect to amount. So in relation to this question, there was opening stock in the question. That's stock in trade. Stock in trade. 1st January 2003. You see, first. So it means the first day of the month of the year. That's the opening, what we are starting it with. It was what 4,520. So that 4,520 we call it opening inventory or opening stock. 4,520. Then we add our purchase because this 4,520 will not suffice us for the year. It will end so young for the year. We have to sell more, so we have to buy some in addition. So we bought 32,150 in addition to what we already. Please, you understand? So we bought 32,150. Okay. Let me do it this way so that you people will understand. 32,150. Now, and I told you that if there is carriage inwards, that's the cost of moving the goods from the market to your warehouse. You have to add it. By any expression, I'm not seeing any cost of that thing. So that carriage inward should be added. Let me not put it in brackets so that you think we are subtracting. So we should add it. Okay, you add it. So you add the carriage inward. But here there was nothing like carriage. So this purchases amount will come in. Please, are you understanding?
We are
Hello?
on it.
Okay, you let me not bring the carriage inward. I'm sure a question that has carriage inward will pop up in the next time you do accounts. Okay, 32,000. Okay, let me not bring the carriage. This question, there is no carriage inward, there is no returns outward. I'm not seeing it. And also, okay, and even there is no, okay, this is a simple question. So let me treat it as simple as it is. Okay, so we add the opening stock to the purchases, which is the 4520 plus the purchases. So we get 36,670. Now, then we less our closing stock. Now, this becomes cost of goods available. Now, you see, the reason why we less our closing stock is that, listen, at the beginning of the period, after adding your purchases, what you bought for the year to what was there at the beginning, you should know the goods you had available to sell. You should know it. Then you transfer all those goods to the marketing and sales department. They sell the products. They will go and sell the products on the market. So when you transfer these products to them, they will sell it. Now, they will sell and come and tell you that, oh, maybe you gave us 100 goods. We were able to sell 95. We were left with 5. Or we were able to sell 80. We were left with 20. But sometimes they will tell you that out of the 100 goods you gave us, we are left with 12. So if they tell you that they are left with 12, that's the closing stock. It should tell you the amount of goods they sold. If you gave them 100 and they are left with 12, it means they sold 88, isn't it? So if the cost of the goods available was 36,670 and they've given you the closing stock, it should tell you the cost of sales, because the difference of the cost of goods available and the closing stock should tell you the cost of sales. So the last additional information, the last one, the last one, the last one,
That stock as at 31st December 2003 was
yes,
4,580.
even as a closing date. So as at the closing of the year was 4,580. So the 4,580, okay. So when you subtract it, it should give you the cost of sales. Okay, it should give you the cost of sales. That's 32,090. And that cost of sales should be match against the net sales to get our gross profit. So you subtract the cost of sales from the net sales to get your gross profit of 18,760. Please do you understand?
Yeah.
Please do you understand? Up to gross profits. Okay. So from here we add other income. And the other incomes I'm seeing in this question is one, discount. Oh, this is funny. Discounts received. So some discount received. You can see it has a credit balance. 300. Told you that all incomes have credit balance. So discount received is one, and it has a credit balance of 300. So that 300 taken. So discount received for 300, and also the next one is interest on deposits account. Now, you see, we did some workings. Interest on deposits. This workings time. Interest on deposits account. And I told you that you credit income statement with 700, you debit asset with 700. So that's what we are taking. We are taking the income statement aspect because we are dealing with income statement. And I told you it is a gain. From here, I showed you that it was a gain. We deposited 500 in a bank as fixed deposit, and the bank agreed to pay us 14% on our deposit. So the 500 will mature 700 cents as interest for us. So that interest becomes a gain. So that gain will be treated as other income. 7. So we add it to this, then we get 1 as our other. So our total income becomes 19,700. That's our total. Then we less operating expense, or what we call fixed cost in quantity. We call it fixed cost. So it's is any question? If there is no question, I'm continuing. So the operating expenses, we start with rent. So we bring our rent here. The rent in the trial balance was 3,140. This thing I eat it 3,140. Then we add the rent owing, and the owing is 460. This amount. So we add it 460. So when we add it, what we get? Plus 460, which is 3,600. That's the income. This is it. And I told you that that would go into the income statement. So this is it. Then we take another one, general expense. So we come general expense. So the general expense, we take the trial balance. General expense as a trial was 1,000. 400. Then we add the oil, which was 200, to get 1,600 as the interest. That's it. Please, I believe you understand. Then the next one we tackle is, I think, interest on loan. The interest on loan, this thing has started. Uh-huh. So the interest on loan was 500. And I told you that the 500, we will debit expense for the 500, credit it as a liability. Because the interest, we took loan from the bank, 10,000, we agreed to pay 10% interest. But we've not paid it because in the trial balance there's no interest. So interest on loan, so interest on loan. So as per trial balance, it is zero because we've not paid it. But the interest incurred is 500. So we have to pay all the 500. So that 500. Now, the next thing we treat is called bad debts. Bad debts, it was 200. It was in the additional information. So we treat that bad debt as 200. So bad debts, there was no bad debt in the trial balance, but additional information 200. So 200. Then we treat, I think something came before depreciation. Okay, nothing came before depreciation. So the depreciation. So depreciation, we can set that one. I'll just come and take the 1,200. Uh, So depreciation. So yeah, I've indicated the working. So I don't have to show the working unit. So 1,220. So it means that if the person marking goes into our workings, you will see how it got that 1,220. Sometimes you can even just write working for bad debts so that you don't even show any working. So the person will just go to your workings over there to show, to see the workings that you're talking about. Okay. So please, when you add all this, you go into the question again to see if there was anything that you've not added, any expense. You know, expenses are, oh, expenses on purchase. I didn't see this. This is carried inwards. So please, let's adjust it. Okay. This is carried inwards. Otherwise, our profit figure. So, like I said, I didn't see it. So, let me think it. But I'll adjust everything right. So, if you miss something, so add purchases, that's 32,000. 150. Then we add the expenses on purchase. That one was 1. So when we add the two, I think this side will be increased by 1. 670 plus 8, sorry, 820. Then so 36,820 minus 4,580 give. So I think our profit has just overstated. So when we subtract the cost of sales from this, I think these two should be reduced by 1. Yes. So we get, instead of 760, we get 610. And get to 610. So I've corrected this, so we can. So we look for other expenses. So other expenses that we didn't do adjustments on them. So I'm seeing selling expenses and discount allowed. And I think they are the only expenses I'm seeing here. So we bring them. So selling expenses and discounts allowed. So selling expenses was 1,300 and discount allowed was 100. So 1,300. When we are done, we add everything. So please, any question?
Paul, please, I request that after today we have another session on this again. I don't know about others anyway. I'm following, but I think today we will not. We will, I am speaking for myself. Then let me speak for myself.
Okay.
Today I'm following the steps,
Mm-hmm.
but I would be happy if we can go over this topic. If not today, another day again. Thank you.
So, like I said, it is about accounting is a practice. This thing you have to practice it over and over again to know the formats. The reason why I can do it, even I know that I made a mistake up there and I could even rectify the mistake so simple, is because I know my format of it. Okay, it's a practice. The more you practice, you know it. It's not difficult. Trust me, it's not difficult. But just that when you practice it, you can do it. So please, maybe we might not get a time to do this same question. I know we will solve another question, and that other question might be different from this. So that's why I'm recording this section. That on your own comfort zone, you can just be
Okay.
going through.
Okay.
Okay. Already, I have a similar question like this, but that one even is more detailed. Okay, on the YouTube channel, you can just go to the accounting section. You solve that one and you use that one to learn, and you can use this one to practice. Okay, so already this this is the second video I'm doing on this. Okay, so you can just practice. I know we will do a last one, but don't wait for us to meet before you would learn it. Otherwise, I'm telling you the truth. We are all deceiving ourselves. Okay, so let's find time to go over, and whilst you are going over, be doing it yourself. You do it yourself. If you get it wrong, you watch. Oh, where did I get wrong? I'll get you guys screenshots, so you can just use the screenshots to also follow. Okay, 19610 minus. So I'm continuing. 8,570. So I'll get 11,040. I'm sorry. I want to use the red. Okay. It's not because it's a profit. Okay. Let me write net profit. Okay. Now, the reason why I'm using red is that I will show you something. And also, you see, now, even if there is a mistake, you wouldn't know, but you should be able to know where you did your mistake after you are done with everything. So I'm not saying there is a mistake, but I'm presuming maybe we didn't include something. Okay, let's presume maybe we didn't include something. I pray such an incident. Okay, maybe I didn't include something. Okay, but if it's balanced, yeah, fine. I will not be able to show you what I'm trying to say. So okay, limited. But I'm praying it doesn't balance. So now I'll show you how to correct financial position asset. That 31st December 2023. I'm sorry, 2003. Now, so here you bring your currency service, but you can say cost accumulated depreciation, net value first, then you bring your currency. Because we are coming to start with our non-current assets. Okay. You see, I told you guys that we start with our assets, the non-current assets first, before we go to current assets. So this is the non-current assets section. Okay. So the non-current assets in the question are two things: building and furniture and fitting. So building and furniture and fitting. So building and furniture and fitting. So the building is 22,000 and the furniture and fitting is 1,200. So when we find the total, we get 23,200. The admins are I can one them pay one the master room where they take pay one. Okay. So the depreciation of hello. So the depreciation, the depreciation that we calculated. Right. So depreciation, you see building we had 1,000 and furniture and fittings we had 120. So you go to your question. If there is any depreciation provision over there, that's accumulated depreciation in the question. So if there is any you add it. But with this question, there is no depreciation in the question. So you just go to your financial this so you bring the 1,100 for building and the 120 for the furniture and fitting. So you get 1,220. That's the accumulated depreciation. Now I told you that net book value, net book value is the cost minus the accumulated depreciation. So to get the net book value, it becomes 22,000 minus 1,100. That's 20,900. And year two, it becomes the 1,200 minus 120, which is 1,008. Okay, 1,008, 1,008. So when you add both, you get 21,908. So we are down with non-current assets. But there was another non-current asset, which is fixed deposit. Fixed deposit. So that's 5,000. It is an intangible asset. So we bring it, but it's also a non-current asset. So the 5,000 fixed deposit, add, okay, 5,000 to add. So when you add it, you get 26,000 as your non-current asset. Then you add current assets. So current assets, you go through the additional information. I don't think there was that much the additional information, but let's so the current asset that we take will be the first one. The You see the closing event we treated here. The closing stock we treated here of 4,500. That's the stock that is remaining. So it is part of our current assets. And that closing inventory will be used in the next year. The going concern concept. I told you that the business will continue to exist for a foreseeable future. So it foresees that next year it will still be in operation. So therefore, this closing inventory, they will not throw them away. They will use it next year. And since they have them, they include it as their current assets. There's asset that they have current. So their current assets, the first one they talk about is their closing inventory. So stock. And the closing inventory amount was 4,508. 4,508. Oh, sorry, please don't bring it there. Okay, bring it. Four, 4,508. Okay, so now becomes the closing stock. Now, the other closing stock becomes the receivables. The receivables here. And you know that the receivables, there was bad debt. So we deducted the bad debt. So that bad debt will reduce the receivables figure by 200. That's the net receivables of 7,300, the one that we. So receivables, like, right? That's 7,300. Then we look into the question to see if there were any other assets. So you see, I told you that we did working for fixed deposit. And I told you that working for fixed deposit, we will debit it as a current asset and also credit it in the income statement as income or revenue, sorry, or as other gain. So we've done the other gain aspect. So we have to debit it as a current asset. So that's what we have. So interest on fixed deposits, that's working 5. Yes, working 5. Working 5. That's 7. So add our cash in hand and our cash in bank because we've already added the debt. That's the receivables. Okay. Receivables or debt. So what we are left to add is cash bank, cash. So the cash in hand is 814 and the cash at bank is 10,970. So when we add, or I think we are done with our current assets. So when we add 4,580 plus 7,300 plus 700 plus 814 plus 10,976, and we add or we get 24,000. 370. So when we add it to the non-current assets, we have 26,980, which will give us 51,300. Let me also use red ink for that. So which will give us 51,300. Now, so when we are done with this, go to the financing aspect. So we say finance by, and we know it is capital that we finance with. It's capital debt. So I told you that finance by capital. We are done with this too. So we are finance by capital. And the capital we are talking about is the opening. That's the one in the question. So the opening capital is 25,000. So that's 25,000 comes. Then we add our net profit. Now the net profit is what we got from the income statement. So the net profit we got, that's 11,040. Then we less our drawing. Now in the question we ask ourselves, were there any drawings? I don't see. Okay, proprietor's drawings 750. So that drawing will be subtracted. So we subtract that drawing. Let me put it in the bracket. So 25,000 plus 11,040 minus 750 will give us 35,200. So we say add non-current assets. So the non-current assets here is 10% loan, which is 10,000. As you can see here, the 10% loan, but oh sorry, loan is a liability on the credit. So 10,000. This. So that 10,000 will be treated. Then we see that's the only non-current asset. So we add current asset. And the current assets we have are payable, which is also known as creditors. So the creditors figure was so debtors and creditors. So 4,900 because it's a liability. So 4,900. Then we add the owings. So you see there were some owings, rent, and there were some owings. Hey, where did the figures pass? Yeah. So there was rent owings of 460, and general expenses owings of 200, and also interest on loan owing. See, I told you the interest on loan, it is due, it is owing. So all those things we add them. So rent, rent, general expense, then interest on loan. So the rent was for something. Let me check. I think it's cost. General expense was 200, and the interest on loan was 500. So when we add or get the total, which is 1,160. So when we add it, let me check whether that's the only liability. I think everything has been treated. Need everything treated. So when we add it to the 4,000, we should get 6,060. And when we add all the three, that's the equity or the capital, the non-current liability. Hey, sorry, it should be non-current liabilities, not non-current assets. And yet non-current liabilities, not assets. Okay. And the current liabilities, we should get what our total assets is. So 35,290 plus 100,000 plus 6,000. Yes, I'm getting 51,300. So it means it has balance. Unfortunately, I don't solve a question like this and it will not balance. So this is the end of today's section. If you have any question, please you can ask. I know at a point there were some distractions which I had to wait some more so that we continue. But please, not without that, any question.
Honestly, I followed up to a point.